Hey guys, welcome back. Today we are starting a new journey to gain superior returns in the stock market. Yes, I am talking about momentum investing. This is a strategy which I have used to beat the markets not just by a small amount but by close to 20% on top of Nifty return, and that took consistently over the past 5 years. Now, what does the average retail investor generally do? What do we intuitively do? We are taught to buy low and sell high. This is why people rush towards cheap things. When a stock falls 50%, we immediately think, wow, such a great discount. But here's the problem. You never really know how low a stock can go. Let's say a stock has fallen by 50%. How much low do you think it can go from that point? Another 50%? No. Look at the math. Let's say a stock is at 100 and it falls to 50. You think, oh, a 50% fall and you want to buy the stock. Then it can fall another 50% to 25. From that 25 point, let's say you invest some more. It can fall another 50% to 12.5. It can keep falling from to whatever levels from the point you brought it. So you never really know what the bottom is. All you're doing is catching a falling knife and you're sure to bleed in the process. And even if the stock doesn't really crash, it can still stay at the same level for years, for decades, with zero returns. That is just dead money. And all your calculations on the Excel sheet of assuming 13%, 14% returns are gone. Let's look at Reliance. If you go to the chart, you can see that in January 2024, Reliance was close to 1500 levels. It is at that same level 2 years after that in 2026. So that's 2 years of wasted opportunity, 2 years of not getting any returns. You might think, well, the entire market didn't go anywhere. But that's where our strategy comes in. We can make returns irrespective of market regime. Most of us go in with no strategy, right? We just buy on tips, we hold on hope, then we sell it when everything seems red out of fear. We need a system. We need answers to these 3 golden questions in investing. What to buy, when to buy, and when to sell. These are 3 golden questions. You also have a 4th one of how much to bet at each of these time, how much to buy, but let's cover that later. So now here is a controversial truth. Momentum investing is not about buying low or finding discounts. Momentum investing is in fact buying high. This seems counterintuitive, but hear me out. You buy high and you sell higher. Now the most obvious question you'll ask me, what if it doesn't go higher? That is the game we are playing. We will find quality stocks which have strong momentum behind them, which are more likely to continue their momentum. And every bet we make is a probabilistic bet. We need to know what we'll do if a plan goes in our favor. We need to know how to manage risk if a plan does not go in our favor. This is Richard Dreyhaus. He is considered as the father of momentum investing. While legends like Warren Buffett and Charlie Munger look for value, Dreyhaus proved that you can make a fortune by buying stocks that are already winning. Let's look at this ICICI Bank chart. A value investor waits for a dip that never comes. A momentum investor buys at point A or point B and sells at point C. We don't fight the trend, we just ride it. Now there are 3 different types of momentum. We have downward momentum, where the stock is really on a downtrend. Then we have sideways momentum, where essentially there is no momentum and the market is sideways. And then we have our positive or upward momentum. This is where we make most of our money, unless you're short selling, which I highly advise you don't. So now that we understand what momentum means and what momentum is, let's look at how I build my portfolio. We look at individual stocks when we define momentum, but we need to zoom out and focus at a portfolio level. We cannot be spending our day sitting in front of a computer looking at thousands of charts trying to find out which stock will perform. No, that is not the approach we follow. Ours is a very passive momentum strategy to beat the hell out of markets. So I have a 7-step framework which I use to generate superior returns. You don't have to do all of this manually. I'll teach you how to automate them. But it is important to understand each of these 7 steps or these 7 pointers so that you're clear on what to do and when to do it. So let's start with the first one. Identify strong sectors. Have you heard of the phrase, birds of the same feather flock together? Which means if a sector has tailwinds, then most of the stocks in the sector tend to do good. For example, we saw that recently in defense, where with a lot of defense investments, a lot of wars and political tensions going around, defense stocks skyrocketed. And not just a few stocks, almost all stocks in the defense universe started skyrocketing. So we need to understand and find out strong sectors. Once we find out strong sectors, we should not over-concentrate in 1 or 2 specific sectors. We need to diversify across sectors. Diversifying across stocks in the same sector is again putting your eggs in the same basket. You might have 5 eggs, but you're putting them in the same basket, and if that basket drops, you're gone. So identify strong sectors and diversify across these strong sectors. 2. Identify stocks which are close to 52-week highs. Again, this might seem counterintuitive, but you want to invest in stocks which are proven to be winners. You want to invest in stocks which show good character, which resist the fall. This shows that there is institutional backing for these stocks. Institutions and big funds are not letting the stock price fall because either they are investing more or they are not selling even when the market is in a downturn. This means that you have strong backing. You want to invest in strong players. 3. You need to define a momentum score. To identify your strong sectors, you narrow down on your stocks. I'll tell you how. Let's say it gives you 50, 60 stocks or 100 stocks. You cannot invest in every stock, right? You need to define your momentum score and you need to rank these stocks so that you take the top stocks which you can invest in. A simple example of a momentum score can be, look at the last 6-month returns, look at the last 3-month returns. Weight it by 40, 60, which means you multiply 40% for the 6-month return and 60% for the 3-month return. You add them together and get a combined return score. This can be your momentum score. You rank the stocks in your universe based on the score and you come up with a list of top stocks which you want to invest in. Then there is volume spikes. You want stocks which at the highs show a lot of incoming volume, which means that when the stock is at a high, people want to invest more. Then the fifth one is rate of acceleration. You want stocks which from the bottom rise at a 45-degree angle. You do not want stocks which rise slowly and eventually go into a choppy phase. You don't want stocks which rise like a rocket vertically up just to fade once they lose momentum and fall significantly. You want a sustainable 45-degree angle which tells us that this stock has continuous buying and people are not letting it fall. The sixth is clean and choppy move. You do not want stocks which are choppy. You don't want stocks which form higher highs and then come down to form lower lows. You want a consistent pattern. You want stocks to keep making higher highs, higher lows. And finally, the seventh one is RSI surge, where you want the stock which is breaking out to go out with a strong RSI above 60. Again, we'll talk about why and we'll talk about each of these factors in much more detail in our series. Just understand the broad concepts of what we look for in a portfolio for now. So let's take a simple strategy. Let's say you want to buy a stock. You filter your universe. I'll teach you in just a moment on how to do that. You identify a stock. Then you identify if it's near the 52-week high. And let's say once it breaks its 52-week high, you wait for the next 2 weeks to see if the stock is holding its 52-week high. Let's say the stock is able to hold its 52-week high for the next 2 weeks. Then what you do is you go in and buy the stock. You keep a profit of 40% and you keep a stop loss of 20%. So this is a 2:1 risk to reward. Let's say since it's already holding its 52-week highs for 2 weeks, let's say worst case, the probability of winning is 40% to 50%. Even if out of 10 stocks, 5 or 6 go against your favor, the 3-4 stocks which work in your favor will give you more returns because the risk to reward is 2:1. Understanding risk to reward, understanding what expectancy is, and understanding risk management are essential. Not just to stock markets, but also to your life. You can apply this anywhere, in playing a game, in betting against others, in understanding human psychology, in thinking in terms of bets. I would highly suggest to read the book Thinking in Bets by, I forgot the name of the author, but it's a really good book. So yeah, is the strategy foolproof? No strategy is foolproof. But this is a mathematically sound, back-tested strategy which has a positive expectancy. So yeah, we've come to the end of the video. We have deep dives on each of these concepts and towards the end we'll know how to craft our entire portfolio. But let's say you're just watching this one video, I want to leave you with one crucial concept so that you don't go and invest in garbage stocks. I'll teach you how to narrow down on your universe so that you invest in good quality momentum names. Let's go to screener for this. Go to a new screen and type this query. Put the market cap between 2,000 crores and 1 lakh crore. Put the current price above 50 rupees. You do not want to be dealing in penny stocks. Put the rate of return over the past 3 months is greater than 5%. Rate of return over the past year should be greater than over the last 1 year. Volume over 1 month should be greater than 1 lakh. And the 50 daily moving average should be greater than the 200-day moving average because we want the stocks to be in an uptrend. We do not want to catch the bottoms. We want the stocks to be at the all-time highs. So from the 52-week high, it should be less than 25%. The fall should be less than 25%. The return over 3 months should be less than 150%. A lot of you might wonder why is this the case. You do not want overextended stocks because stocks do not keep going above forever. They will crash. You do not want overextended stocks. You want the return over, again, this is just a sample formula. So let's say you run all this. You have 54 stocks. So these are 54 stocks which are good stocks. You have not defined a momentum score yet. You have not ranked the stocks yet. This is just to narrow in on the universe. Let's say you're someone who also values fundamentals. Just go and add one more fundamental filter here. Let's add a debt to equity ratio of less than 1. So if you do a debt to equity ratio of less than 1, let's see what happens. The stock list had narrowed down from 54 to 35. So these are decent stocks which do not have a lot of debt. And trust me, debt is the primary thing which kills companies. Over leveraged companies are the quickest ones to fall. If you're a fundamental investor, I will also talk about fundamentals and what are the exact things to look for. You do not have to go about reading income statements, balance sheets, profit and loss. You don't have to do all of that. There are a few key aspects and few mental models which you need to remember to do fundamental investing. Let's cover all of that post this momentum investing series. This isn't the perfect system yet. We've not really ranked the stocks. We've not really covered what rebalancing means. We've not really covered how to enter and exit and how to manage risk. All of this will be covered in our subsequent videos. But with this, at least we won't be buying garbage companies. So finally, what are the risks for this? Do not invest in penny stocks because this strategy works on liquid stocks which have decent momentum. The screener query which I gave would hopefully avoid these penny stocks, but be very careful to not apply this momentum strategy on penny stocks because you don't know what a circuit limit is. You do not know when a stock will keep hitting consecutive lower circuits for 5 days straight or 10 days straight, and there is nothing you can do about it rather than just watch the market in red without an opportunity to exit because no one is willing to buy that stock. 2. Diversify. As I said, diversify across strong sectors, diversify across stocks, but most importantly, diversify across sectors. And we also have diversifying across investment classes. That is when the market regime is negative and momentum does not work. You need to know what else to do. We'll cover all of that. So we've come towards the end of the video. Tell me what strategy you currently use for your investments today. I hope you enjoyed the video. Stay tuned for upcoming videos delving into each of these topics. And by the end of this 4 or 5 video course, you will be able to craft your momentum portfolio. Look out for weekly updates. I plan to post once a week and I plan to cover this over the next month. I will give you an entire framework completely for free. People charge lakhs and lakhs to do this. Hopefully you find value in the content which I offer. If you do, and if you enjoy the video, please do consider subscribing and please do consider liking the video. That will mean a lot to me for the amount of effort I put in post my daily job. You know how exhausted we are post our jobs, but I still come, try to deep dive, try to analyze and try to give you quality content. Subscribe to the channel and hopefully share this video with your friends and family members. So stay tuned. Until next time, this is Andrew signing off. See you soon.
And tell me what's wrong and why you never said you felt that way. And guess you're trying to stay strong and fake a smile until I look away. But I've known you too long, it hurts to